Sorry for the delay. So I'm going to upload a solution for your homework, and also I'm going to upload your next homework assignment about central banking, and that's also going to have the solution. And the format of the exam is very similar to the format of the homework. Okay, these T-bills, and this is it. It's either you got the right T-bill or you didn't. It's pretty simple, but I guess this format allows me to come up with lots of questions, right? Any type of transaction in finance, and we're going to go through pretty much all of them, has a place on the balance sheet and in the income statement, and you either understand it and are able to put it in a T-bill or not, and that makes it pretty straightforward, I think. But yeah, then again, don't worry about it. As long as you don't completely flunk it, then everything's gonna be fine. Any question about this lecture note? So we've gone through credit card debt. I think that's quite interesting. Deposits. All right, so we skipped time deposits. The time deposit is just has a little bit of maturity in it, and then you lock it up for a year. This used to be, in the old days, something more different than just a regular on-demand deposit, but nowadays you still get next to nothing for putting it in a time deposit. So the difference has become less significant for retail clients. There's something called deposit duration modeling. Okay, you guys do realize that your money is in the bank and you've had maybe a positive balance. Hopefully, you guys are students, you never know, maybe you could be in debt, and that's fine. But most people, if they have bank and they have money in the bank, it kind of lies there and doesn't come out for sometimes forever. And there's always a positive balance in people's accounts most times, and you can model that as having effective duration, right? So going back to the bank's balance sheet, which I gave you a summary of here. So these 400 billion Swiss francs, which are due to customers, these are the deposits. These, well, just a portion of them is really contractually on demand. So let's say of these 400, maybe 200 billion are contractually on demand deposit, meaning the client can withdraw them at any point in time as he wishes. But even those 200 billion have effective duration. Okay, so on average, and observing clients' behavior, these deposits they stay there for more than overnight. They don't go out every night and then come back. And so the bank can take this into consideration, run a few models with regressions and stuff, and this is one of the few places in the bank where academics with their regressions are actually needed. But then again, they're not the one managing that division or that department. They just run a few regressions. And just to give you, I want to convey to you that the actual skill of being able to run regressions is only really very few actual jobs that require that, and yes, there's plenty of people to do that, and that's it. So, like, the point is that digging deeper and deeper and deeper into these academic methodologies doesn't get you where you want to be, unless that's where you want to be, and that's fine. And the bank takes this into consideration, lends the money out for a longer duration than overnight. Okay, so the bank is allowed to some extent by the regulator, and wants to some extent on his own accord lend the money out for longer duration than just overnight. Okay, and of course the marketplace is such that whoever can commit to lending money for a longer duration and for riskier projects, then on average it gets a higher return. If you think about it, that's just kind of the risk and reward of this world. And so the bank makes more money the stickier the deposit base is. Okay, it's kind of free financing for the bank. And you do have some regulatory limitations on that. So the effective duration might be 3 to 4 years. Okay, so they've estimated that on average, of course, this can turn quite quickly. So in the great financial crisis, banks were in distress, and then some clients, with respect to some banks, maybe all clients of some banks wanted the money out right here and now. So maybe in good times they were modeling 4 years, but today is today, and everyone wants the money out today. And so you have to take this estimation with that kind of caveat. And the regulator, I've come to know, that has even a specific restriction on this effective model duration. So maybe the effective model duration in good times might be 3 years, but the regulator might say you are not allowed to model this as having more than 1 year duration, just because we want to enforce this on you. So the regulator has gone into the bank's models to minute detail, to an extent that you wouldn't think is realistic. So the regulator is really inside the banks. I wouldn't say inside the banks, but they are very well aware of all the bank's methodologies down to the parameter. Even though, in my opinion, this is not the right thing to have. I mean, it should be, in my opinion, okay, this is my opinion, it should be more kind of out of touch. The regulators should be further away from the banks, but there should be other kind of mechanisms allowing the banks to fail. And then if they fail, it's fine. We don't need to rescue them. And then we don't need to intervene so much to begin with to prevent them from failing. And I think the one thing that's easily could be done is allowing the public to deposit money with the central bank directly and not force them to take risk with the banks. Think about it as the simplest thing in the world. Talk with it with your economist professors, and they're going to get quite angry because it's such a simple solution, which kind of illustrates that they don't understand the very basic banking activity. And so they've dedicated their lives to the study of finance, which they don't really understand at the very basic level, and then they get very angry about this kind of idea. And this is also a very academic kind of inclination to get angry at other people's ideas, but that's people. You gotta learn to live with them. Another very interesting topic that I wanted to talk with you about. I do have one exam question about this. I don't know if it's gonna appear in your exam, but I wrote a question about negative interest rates, so and it appeared last year. If any of you come across last year's exam, you let me know, right? And because that's a big no-no to pass it on, because every question is just completely new that I wrote up from scratch, and nobody has anything anywhere similar to this. Negative interest rate environment, okay? This has been a hot topic up to last year. I guess people have gotten used to it, and they've stopped kind of pumping this in the news. And you see, nothing really happened. It was all over the news. People said negative interest rates, and it's gonna blow a bubble, and people are gonna hoard cash, and all sorts of stuff has been said, and none of it has happened. You see, the buildings are still outside. The sun is no longer shining, but that has nothing to do. And the economy is still running. And yes, you have a new president of the United States. Also has nothing to do with it. But let's try to focus. Negative interest rate environment. Okay? So just give me a little hint about how much you know about the negative interest mechanism, how this kind of works. Okay? So then I know kind of where to start. Anybody know anything about the negative interest? Yes.
But usually bank, or like the central bank, gives the depository banks a small incentive after their funds deposited in the central bank. In normal times when there are negative interest rates, the depository institutions have to pay the central bank.
Exactly. So that's precise, and that's precisely the mechanism. So we're going back to the central bank's balance sheet. Central bank, and has deposits from the side deposits from the commercial banks, and this is rolled over into government bonds or some sort of securities. And usually the banks get a positive rate of interest on these deposits, but the central bank, being in charge of this database and having the authorized employees to change 100 into 100 plus some sort of interest, they can do that, and so they can decide to either remunerate that as a positive or at a negative interest rate. Okay? And the banks as a whole can never escape this. You remember, all the money is there. The only way to escape it is, let's say, if this was actually 90 and 10 was redeemed in hard cash. So everywhere I call a deposit, I call cash, and notes, I call hard cash. That's just my kind of notation. Okay, so these deposits are redeemable to hard cash, and you cannot charge a negative interest rate on the hard cash. So there is a natural limit to how negative you can make this interest rate, because if it's so negative, then the banks would say, okay, forget about the convenience of having everything electronic, let's take it all hard cash and go back to the Middle Ages. And not pay anything on this. Okay? And if you ask the banks have kind of vault services for the clients. So if you're a big client and you want to deposit, say, 1 billion francs, and you have people, individuals like this in Switzerland, they have 1 billion cash in different banks, and they want to, they come up to the bank and say, okay, I want to withdraw 1 billion hard cash. Why? Because you, the bank, say I'm the client, you, the bank, have been all right with me having a deposit with you for 1 billion, or and I was receiving 0 interest rate, but now you came up to me, listen, and for these reasons, you told me, listen, the cash you keep with us, we cannot lend onwards to other clients and make a profit or even a positive rate of return. We need to keep some of that with the central bank, and then the central bank charges us, and therefore we need to charge you. And then you've told me this, okay, I understand you need to start charging me, then forget it, just give it all to me hard cash. And then this is a problem, okay? This is a problem. And the banks would refuse that, even though the retail contracts, so the contract that the retail client has with the bank allows them to always get it in hard cash as he wishes. But with larger clients, there is a clause saying there that no, forget it, you're not going to get 1 billion hard cash. And if you want to deposit with us, then no, you cannot take hard cash. And similarly, the central bank imposes that on the banks. So to some extent, the central bank allows banks, well, you need a little bit more cash, no problem, we can still operate as we used to, but no, you cannot now ask for 10 billion hard cash from us. Okay, so there's some sort of soft, potentially hard constraint on this redeemability, because the central bank has decided they want to have a negative interest rate. And so if they're gonna allow people to take it hard cash, then that's going to negate that, the effect of that policy. So all these things you gotta keep in mind, that this is the main issue about the negative interest rate, is the redeemability of a sight deposit to hard cash. And hard cash, you don't pay or earn interest, and that's why there is kind of a natural zero lower bound on how negative interest rates can go. And then if you are a big client, you want to keep all that cash in the vault of the bank. Where else are you going to keep it? If you want to keep $1 billion Swiss franc in the vaults of the bank, and they're going to administer all the security for you, then that costs maybe 50 to 100 basis points per year. Okay? So that also costs all the people and the facility and everything. So that also costs about half a percent up to 1%. And that also gives you kind of the natural cost of cash. Then again, I think this whole thing is really not as relevant as people thought it was up to 1 year ago, but now people seem to kind of come off the idea that this is such a crucial kind of little nuance that we've reached in the economy. Again, this is a behavioral bias. People never fully understand finance, and so they tend to think that the bottom can drop out of the barrel of the bucket at any point, and things can just kind of explode, and the economy can just, and the stock market's gonna crash. People have this behavioral bias. They think that things are gonna go boom all of a sudden, and so they're looking for the next excuse, what can trigger this. And at the time, negative interest rates were a new thing, and naturally people were thinking maybe this is gonna cause some sort of financial crisis, but it's really not a big a thing to cause anything to go one way or another. So let's go over these points. So first point is there's a floor on how negative interest rate can be charged on depositors. And this is because they can always withdraw the money cash, which pays no or earns any interest. Okay, that's the one thing that I've discussed. Point two is bank deposits is a liability to the bank towards the client. They're not rolled over in their entirety to central bank deposits. You remember here you would have a bank balance sheet, and not all of it gets rolled over into central bank. Some of it gets multiplied and lent out, and then they do have the chance to get a positive rate of return on that. And but this is how negative interest rates permeate the entire economy. Okay, well, if you start at the source and you charge a negative interest rate here, then this gets counted into the calculation of all lenders and depositors. Okay, so the bank would say, there's only so much I can lend onwards. Some of it I have to keep with the central bank. And so, like the rule of one price, kind of, this is how it permeates through the economy. So then the next safest thing, like a government bonds, they react almost immediately. Everything kind of reacts almost immediately, but the prices get equalized almost immediately with the next safe asset, which is government bonds, and so on. Okay, that's the one point. Oh, another point is that, in effect, they don't charge the entire deposit base. The central bank doesn't charge the entire deposit base a negative interest rate. They have a two-tiered kind of system. They say, okay, you're a bank, say Credit Suisse. You have 100 from clients deposits, and then you need only 10 to have with us as required reserves. You remember that one from central banking notes? but then maybe you keep 20 with the central bank and 80 in loans. So the Credit Suisse is keeping in effect 10 more than its required amount of reserves. So it's keeping 10 in excess reserves. All right, so it's keeping 20. Why? I decided to keep 20. It only was required by the central bank to keep 10. And then the central bank might say, of these 90, only 50 are required reserves and 40 are excess reserves, and we're only going to charge a negative interest rate on the excess reserves. That's why they decided, okay? So it's kind of a two-tiered system. It's more kind of a gentle thing. So you need to understand that it's not the whole deposit base that's being charged a negative interest rate. It's just the marginal dollar, the excess, is being charged a negative interest rate, and that is enough to make these negative interest rates diffuse and permeate through the entire economy to government bonds and other safe assets, such as short-term deposits of safe institutions with safe institutions. But then again, loans, personal loans, credit card loans, they're still charging the 9, 8, 10%, okay? That doesn't get really affected by that. The difference between 10 and 9.5, okay, that doesn't really get priced in there. Okay, so the third point is that large banks do subsidize retail depositors to a certain extent. Okay, so these 400 billion, yes, only cash and balances with central banks is only 91 billion. Okay, so this is really the 20 here. This is it. Okay. This is assets of a commercial bank, a big bank, with the central banks. And here is the deposits from the clients. And everything's kind of built around this. And here's the next loans. Okay, so really a large international bank is built like this. There's deposits from clients, rolled over into loans, rolled over into balances with the central bank. And everything else is kind of built around that and is kind of small. Yeah.
So why are the totals for assets and liabilities not adding up?
Because you have equity. Equity is the difference. That's a good one. And so, yeah, these deposits are not as profitable as they used to be. It used to be that banks, so of course this all depends on the market structure and interest rates and competition, but it used to be that, yes, every dollar we get from a client is very profitable for us because we can lend it on and make an interest rate margin. But since 2008 came something called liquidity coverage ratio. Okay, so you remember the required reserves? It's kind of a variation of the required reserves. The central bank tells the banks, okay, you have 100 from clients, you have to keep at least 10 with us because we don't want you, it's kind of a paternalistic, we don't want you to be in a situation where you don't have liquid cash to be able to meet redemption requests by your clients. And then came the financial crisis, and this kind of paternalistic constraint by the central banks was insufficient, and then they've made those requirements even harder and more kind of refined, and then this made the deposits less of a flexible liability to the bank. Okay, so it used to be, yay, we got money from the clients, we're gonna lend it out, we're gonna make some money. And now it's like, oh, we get money from the clients, we can't really do much with it, we need to put it either with the central bank or into high quality liquid assets, HQLA, which is a very kind of narrow definition. Certain assets qualify. Certainly a deposit with the central bank qualifies as HQLA, that's the HQLA, but also other instruments like short-dated government bonds would qualify as HQLA or AAA, AA, I think even AA, as short-dated deposits with other commercial institutions would also qualify as HQLA, but all these things have been repriced off the negative interest rate. So it's really, really hard to pick up basis points, to pick up some income from this source of funding. Okay, so it's been like, okay, clients, we don't really need your money anymore, but we're not gonna be totally not nice to you by charging you a negative interest rate, even though we would like to charge you, we really don't want your money anymore. So we would like to start charging you for having the money with us, which is absurd. But we're not going to. We're going to subsidize you. This is for the retail clients, this is for reputation. Okay, so this is a conscious decision by the banks not to impose a negative interest rate on small deposits for reputation purposes, because people get really angry. A lot of small clients get angry, and guess what? Small people, they have political power in the ballot, but the rich people, they don't. So in this case, the rich people get a worse deal than the small retail clients, because yes, above 100 million cash deposit, for sure, and even above 10 million, I'm sure, you need to start making the bank money if you want to keep that amount of cash. So either you get explicitly charged a negative interest rate for a large deposit if you're a large client, either ultra high net worth or corporate client, or you need to bring in some other business, lucrative business to the bank, and we get there. We can get there in our next slide. We get to corporate banking. Point 4. Okay, this is what I was saying about the hard cash. And yes, there could be a law, a new law saying, at first, yes, right now there's about 28 billion Swiss francs hard cash in the economy, and the rest of the like 500 billion in base money is all in sight deposits. And this is currently the situation. There's a freeze or maybe a cap on how much hard cash can be in the economy. So the central bank can say, right now there's 27 billion, next year there can be 27 billion plus some sort of nominal growth, and no more. And so this way the central bank really makes sure that there is no run to redeem sight deposits into hard cash. That's one way. And then the next step is to say, well, why don't we get rid of hard cash altogether? There could be a law saying it's no longer allowed to anyone, the bills are no longer valid. Everything must be through the banking system. They can do that. That could be done. That would be unconstitutional in most countries, whichever constitution that jurisdiction has. Passing such a law must kind of require a super kind of majority in the legislative body. And then again, why do that at all? Any questions about the negative interest rates? Yeah.
Is that kind of a similar reason why India tried to reduce the supply of the large notes?
I think that was more for anti-money laundering and capital control. So again, it's the two things. I actually was in the same school as Professor Raghu Rajan. He resigned, but he was for a while the head of the central bank in India. He's a very wise man. It was my impression that he didn't quite like the cutthroat politics that he was thrown into, and I saw him one time and he was not looking himself, and then he quit after a year. But the way I perceive what well, I didn't read too much about it, but the way I understand things is there's two reasons. One of them is realer than the other. So the first one is the excuse. The excuse is that we don't want black money, we don't want illegal transactions. Illegal transactions, they take place in hard cash because hard cash is not traceable. And therefore, we don't want to have large bills. That's the excuse, okay? Everywhere, this is a very powerful excuse because all the normal people, all the regular people, all the the officers in the pyramid, whatever pyramid it is, the government's pyramid or the bank's pyramids, they all say, oh, okay, that's the law. And then they get into the states that say, oh, okay, and then the big guys, they get to do what they want. And that's a very powerful excuse, and sometimes a lie, to get to what is kind of clearly the real reason is to keep the capital inside the country, okay? Because once you let people take it hard cash, they can transport it to another place or exchange it into dollars more easily and take the dollars elsewhere, and then your currency might kind of depreciate because there's more of a selling pressure to convert it into foreign currency, okay? It's a form of capital control. And that's what's happening in China, you have capital controls, and that's what's happening in India, capital controls. Okay, so that's the real reason. They think for some reason that if they put artificial constraints on how easily people can move the money abroad, but again, there's no sense in it, all the money is in the central bank anyway, so the act of moving the money abroad is really just the act of exchanging the local currency to foreign currency, and the ownership changes from the local Indian or local Chinese to a foreign investor, and then there aren't so many foreign investors who want this local currency, and so the locals want to sell it more than the foreigners want to buy it, and then the exchange rate would go down. Okay, and that would put the government in a worse financial situation, because they have some external debt and their budget is, they have a lot of expense in foreign currency and income in local currency, so their finances become worse if the exchange rate goes down. So they say, okay, let's tax the people that we can tax, which are the local people. We force them to use the local currency more than they would have liked to by putting capital constraints, and this is a capital constraint, and then it's harder for them to sell it to foreigners, and so the exchange rate, we think, is kind of kept a little bit artificially higher, and a little bit we're able to tax our own people in an indirect way as opposed to direct taxes, and that's the real reason behind it. Again, you can ask Raghu Rajan what he thinks about it. I'm sure he's not institutionalized, okay? So I think he's going to tell you the truth. Any other questions? Yeah.
But why they can put the money in stock, for example, where you can get a high return?
The central bank?
No, the banks, why they don't want to lend money, but why they don't buy stocks, for example?
So there's two things I want to say about this. One thing is that there is, in most jurisdiction, explicit law or rule preventing banks from owning public shares of public companies. So the ones that go up and down and are traded, banks are usually forbidden from buying them outright, as opposed, and this changed. This up until 2008 it was allowed. I know in Israel it was allowed up until 2008, and then it was disallowed. So they had stocks, global stocks, on their balance sheet, just the ones, and I have a lot to say about that in a second, and whether it's good or bad practice. But before I kind of give my opinion about whether it's good or bad practice, So it was allowed, and some banks did it, and then it was disallowed because the regulator perceived this as being risky, and now it's in most jurisdictions disallowed. But then I want to go back to the basics of finance and remind you that loans are no different than bonds, are no different than shares, are no different than stocks, all right? Because they're all a source of funding for other governments or corporations or individuals, and they all kind of provide you with a positive expected rate of return if they're fairly priced. Otherwise, why would anyone buy them when they can hold hard cash that gives you zero return? Okay, so in that sense, yes, maybe they should be allowed to buy stocks. They should be allowed to do what they want. And then why did the regulators step in? Because whenever banks make risky decisions, whenever they turn out badly and they make losses, then the whole economy seems to shut down because people want to take their money out, but they can't really take their money out. They can only move it to a different bank, and people stop lending because there's such high uncertainty. We don't know which bank is going to default, which company is going to default. So it's kind of a musical chair. Because the net amount of money is zero, in my opinion, then the regulator has found the need to prohibit banks from taking activities which in the regulator's opinion are risky and can lead in the future to losses of the banks, which can lead in the future to a credit crunch and the whole kind of music stopping and the economy stopping. So that's the second point. That's maybe the first point, the second point, and then going back to the next point. So you're right that there's no difference between profitable or unprofitable loans or deposits and stocks, which are also a source of financing. But then again, stocks are kind of riskier, so the regulator opted to stop that practice. And then the third argument, which is my argument, it's not a common argument, you're not going to hear that a lot, but I know I have from experience from knowing the CEO and the CFO of the biggest Israeli bank. When I looked at their balance sheet before going to meet them for coffee in Tel Aviv, I asked them, you have 100 billion shekel, divide by 4 to get to Swiss franc, you have 100 billion shekel in assets out of a 400 billion balance sheet. So 300 is in loans that you give to companies and individuals, and that's great, that's your business. And 100 billion of shekels, that's 25 billion Swissies, it's a book of securities that you've bought, mortgage-backed securities that you've bought from originators in the United States. It used to be stocks. The guy who was running this book told me, yes, it used to be stocks, but nowadays we just buy all sorts of corporate bonds. We're not allowed to buy stocks anymore. And I asked him, why do you do this? I asked the CEO, why do you do this? He said, because it gives me money. And I was like, great. So the point is that, yes, it's profitable. Yes, they can take deposits from the public and then issue bond at 1% and roll this over into corporate bonds at 3 or 4 or 5%, and they make additional income. But then again, think of their bondholders, think of their shareholders. Shareholders, they can buy these assets directly. They don't need to buy shares in a bank, and then this is used as a source of financing for the bank to buy these securities which they have access to directly. And the problem is the additional corporate tax rate. Okay, so think of a bondholder or a shareholder. They can buy a bank bond knowing that this money is going to be used partially by the bank to buy securities which they can buy directly, but when the bank does it for them on balance sheet, the income spread, so they pay 1% on the bond, they make 4% on this book of public securities which they purchase, so they make 3% net income, then which is then taxed at about 40% corporate tax rate, this is a tax leak. This is what I call tax leak. Okay, so it's more efficient, obviously, for the shareholder if he could, and he can in most cases, buy these securities directly from the originator, just like the bank did, and not incur this additional 40% corporate tax rate. So why does the CEO say it brings me money and smiles? Because her and the employees, the executive's bonus is more sensitive to net income of the bank than it is to return on equity of the bank. You guys are gonna need to think about that. Okay, so that tax leak kind of gives a lower return on equity to the shareholders, but a bigger profit because it's on a bigger balance sheet, and so bonuses get bigger with a bigger net income than they are relative to return on equity. Think about it. That's my understanding of it. There's very, very few people who ever got to see these things and to think about these things. I've been at the top. Somehow they kind of do these things without fully understanding all the implications, and it's interesting to see. Any questions? Yeah.
So the central bank would use a negative interest rate for what desired effects? Because it seems like when they use a negative interest rate, it makes it harder for banks to make money. But why would they impose a negative interest rate to make it harder for the banks?
Yeah.
Like
Good.
an economical reason that they would do that?
Good question. Good question. You know, my natural instinct is they are people that maybe they should be fired. Maybe they're thinking when they shouldn't be thinking so much about the economy and how to do this or that, and they come up with new things to accomplish some goal. And to be honest, yes, if I start reading all their minutes and all their interviews, then I would get to the bottom of what they're thinking. Potentially. These people don't usually invest their own money, so they're not investors, but they determine things that investors then kind of take into consideration and adjust their actions. And yes, they're very clever. They understand the implications, the implication of the implication. They think about this. They're very smart people. But then again, maybe they should be fired because maybe they shouldn't be taking such active decisions. Maybe they should have more kind of laissez-faire. This is the amount of money, and not play around with it so much to achieve some goals. And then to kind of you making me kind of remember what their argumentations were at the time. It had a one-to-one to do with the removal of the peg to the euro. The Swiss franc was pegged to the euro, so they were crediting newly issued Swiss francs to sellers of euros. So they were blowing up their assets with euros and blowing up their liabilities with newly created Swiss francs in order to keep the Swiss franc to the euro exchange rate at 1.2 euros to the Swiss franc. And then one day, and they were doing that because they perceived the Swiss franc as being too strong. Okay, so this is a big kind of assumption or analysis result of their kind of model of the economy that they have in their head. They came to the conclusion, which most likely is wrong. I don't want to give another theory, I just don't want to have a theory, that the Swiss franc was too strong. So they were buying euros. And then they realized, well, we've had enough. We don't want to do that anymore. We've made a mistake. We shouldn't have been buying all these euros. We should have been communicating that we'll buy any amount of euros at 1.2 euros per dollar. Because guess what? Euros were coming in. Just before they were stopping, they were getting billions of euros. The rate at which they were having to buy euros was really picking up. So it was really like 1 or 2 weeks that the amount of euros they were buying was kind of reasonable for their own appetite. And then it was like, whoa, we're buying billions and billions of euros. Really, it's kind of going exponential. And so one day they stopped. And then the day they stopped, in order to compensate for that, to make the Swiss franc not as strong as it would be without the peg, they lowered interest rates. Okay, so that was to counter the removal of the peg. Then they lowered the interest rate to make deposits in Swiss francs less attractive than deposits in euros. Okay, so when you lower interest rates in an unexpected manner, and that makes that currency less attractive, and then more people want to sell that, and less people want to buy that. Of course, the amounts are already preset, and so the exchange rate is usually pushed towards depreciation of the local currency. When you lower the interest rate, then the local currency usually goes down in value relative to foreign currency. And so they did that to offset the removal of the peg, which led to a huge increase in the price of the Swiss franc. That's what was in their minds. And then again, maybe they should all be fired and shouldn't have things in their minds. They should have other things in their minds. Okay, so all these things we've gone through, this is the products you have in personal banking. Now let's take a break and then we can do corporate banking. Alright, so let's move on to corporate banking. You remember the structure of the course was this personal finance module, then base money, central banking, debt, equities, a little bit about the philosophy of why banks and financial intermediaries are needed. That was last class, and then we go more into the structure of a global bank, being comprised of retail banking, or also called personal banking, and corporate banking, asset management, wealth management, and investment banking. And then in a continuation class, we would go over the central control functions of a large international bank, asset liability management, all this capital management, all the regulatory variables, risk-weighted assets, liquidity coverage ratios, all these things, and how the bank issues bonds to finance its activities, compensation practices at the bank, governance practices at the bank. So that's kind of the natural structure of explaining banking, in my opinion. Anyways, this course I wrote up from scratch. Nobody told me write it this way or another way, but this is how my understanding of finance evolved, starting just like you did at bachelor, moving on to the PhD, moving on to a large international bank, a very specific position in that bank. I was advising the board of directors, and so I got to see the entirety of the bank, and then from there I moved on to start my own investment fund, and this is what I'm currently doing. And then now we're talking about corporate banking, and yes, that's kind of a division within a bank where they serve corporations. The products offered are first and foremost a bank account, okay? And you'd be surprised at how difficult it can be to obtain a bank account for a company. The banks wouldn't just let you open an account if you're just a small company, especially if you're a foreign company. And there might be very legitimate reasons why you would choose to domicile yourself as a company outside of Switzerland or outside of the United States if you're a US business owner. But the banks would say, whoa, we don't want anything to do with that because that's risky for us. We can get a huge fine from the regulator, but there's not so much money in it for us because how much money we're going to see from you anyways. So why don't you go look somewhere else? And you'd be amazed that all of the banks all over the world, they've all at the same time give you the same answer. Okay? Literally, some companies would never be able to open a bank account unless they start bribing the bankers. Literally, it could be very expensive, but yes, for large, big enough sums of money, you can get an account all of a sudden. And yes, banking is still kind of legitimately corrupt, in my opinion. Okay, so you get to make payments from your bank account in whatever currency. You might get access to CLS. CLS, continuously linked settlement. This is a very big company, and it's owned by a conglomerate of banks, and they do international FX settlement. Okay, it's an interesting institution.